Okay, so it is 10:30 and we want to respect everyone's time, so we'll get started. I see some more people trickling in. We've got a number of people on the line today, so I just wanted to thank everyone for being here on a beautiful Saturday morning. We've got a lot ahead of us here in terms of content. It should be about 45 minutes, our presentation, and then we will open it up for questions for another 15 minutes at the end. Now, before I get into today's agenda, just a couple housekeeping items. For everyone attending on Zoom, this is also being broadcast on YouTube as well, but for everyone on Zoom, you'll have the opportunity to ask us questions. These questions will come directly to us, the presenters. It's all private, so you won't be able to see anybody else's questions. Now, if you do have a question about your own personal finances, what we would suggest is we have a link to our calendar in the chat. That will allow you to book a time with Rob and myself, and we can go through some more in-depth or personal items that you might have. So once again, feel free to put your questions in there as we move along and then at the end as well. So in terms of our presentation today, I'll be taking you through a little bit of an introduction to our team. So you'll know a little bit about who's presenting today. Then I'll hand things over to your main presenter, Rob. And he's going to take you through retirement cash flow and taxes. So that's the theme of today's presentation. It's for retirees and really how to manage all of these different areas of cash flow coming in. There's different rules, there's different ways they're taxed. So Rob's really going to take you through a lot of rules and recommendations that we have for our clients when managing these types of income. Finally, I'm going to take you through a little bit on financial planning. So today's presentation, like I said, is on the cash flow and taxes side of things. But when it comes to creating retirement plans, we take a very holistic approach. So we're looking at many different areas of financial planning and really bringing that all together. So I'll wrap up the presentation with that. And then, like I said, we will open it up for questions at the end. So please don't hesitate to throw those in the chat. So a little bit about ourselves. We are Daumler and Associates Private Wealth Management, and Rob and myself are the two financial planners on the team. So Rob has been in the industry since 1993. He is 29 years at IG Wealth Management, so he brings a plethora of knowledge when it comes to financial planning, taxes, retirement planning, financial markets, all of these different things. He's helped hundreds of individuals guide them through that process of retirement. Now, Rob is a certified financial planner. This is one of the highest designations you can get in financial planning. It takes about 2 years to complete all the work to become a CFP, and then you need another 6,000 hours of work experience to actually call yourself a certified financial planner. Now, Rob is also a registered retirement counselor, and he has a degree in economics from the University of Calgary. Now, when Rob is not financial planning, he loves to spend time with his family out in Cochrane. Him and his wife, Marie, have 3 children, 1 in high school and 2 out at university. But they always seem to have a full house with pets and everything like that. Now, I myself have been at IG for 8 years. Prior to that, I was 2 years at the bank. I'm also a certified financial planner, been so for a number of years. And then as of a couple of years ago, I became a chartered investment manager as well. And that's just because for Rob and I's day-to-day work, we do both financial planning and manage our clients' investments as well. So we need to be experts in both of those fields. Now, for myself, I have a wife. I live on the opposite side of the city as Rob out in Chestermere. And we have a daughter who's turning 1 at the end of the month, and we're actually expecting another one towards the end of the year here. So that's a little bit about Robin and myself. Now I'll talk very briefly on the company that we work for. So we are under the umbrella of IG Wealth Management. Now IG is a big company. We're actually the 3rd largest financial institution in Canada. And we've been around a long time. So we've been around over 90 years. Now, IG is strictly a Canadian company. We work with Canadians from coast to coast. And IG, you can see, has relationships with a lot of other financial institutions when it comes to managing our clients' investments. So we take a sub-advisory approach where we're using different sub-advisors to manage each different asset class of our portfolio who have proven track records in all of those areas. So with that, with the background on your presenters and the company, I'll hand things over to Rob, and he'll take you through today's presentation.
Thanks, Lucas. I also want to thank everybody for being here this morning. I know our weekends are short, so I really appreciate your time. We're going to be talking about really your retirement paycheck, all the sources of income that could come into your situation when you retire. I tend to talk fairly quickly, so please, again, use that chat function if there's anything that you have questions about, and we'll try and address that as we go towards the end of the seminar. Again, we've been in this business for a long time, and when COVID started, I did a presentation with Sun Life, and we talked a lot about retirement and how people sort of go through stages of retirement. You can see in here, one of the biggest problems people have approaching retirement is 58% of them are worried, do they have enough money? And so our job as financial planners really bring peace of mind to show people that they do have enough. And I always like to say we need to, create, plans that help people do things on values other than money, so they can make decisions on what's most important for themselves and their family. And 64% of the retirees have problem balancing between enjoying their retirement and making sure their money lasts. And this is very difficult. I always say that some people are savers and they get into retirement and it's really hard to spend. Some people are spenders and then it's really hard to save. And so it's really important that you understand who you are. And I believe in financial planning because it brings peace of mind and clarity around your retirement plan. We've had a lot of clients, obviously, through COVID. Most people have had significant changes in their lives. I've had a lot of clients that said, can I retire earlier, a year earlier, or do something different? And so we've done a lot of work around retirement planning, and we're going to jump into some of that as we go here. But my belief is about 10 years ago, I saw a retirement income specialist at a conference. His name was Tom Hegna, and he talked about retirement really in 3 stages. And, I've been in this business long enough to actually go through all those stages with my clients. And so when you first retire, you tend to be younger and healthier, and we call that your go-go years. And so you're going to be doing more of the travel. You're going to be doing more of the stuff that you couldn't do while you might have been raising a family or working. And so there might be more travel or hobbies and things like that. And so we typically say people spend more money earlier on in their retirement. And then somewhere around, let's say 75 years of age, we start slowing down. That could be health related. It could be, we're just, tired of that travel or whatever it might be. And we call that your slow go years. And people say closer to home, their health costs might go up for travel. And so and especially with COVID, obviously, maybe a lot of us experienced those slow go years a lot earlier than we wanted to, is what's happened in the last couple of years. So hopefully things will start getting back to normal. I know a lot of my clients would like to travel more and do more. And then somewhere around 85, 90 years of age, we call that your no-go years. Typically, people might go into a retirement home. Of course, we don't know how old everybody is on. We can't see who's on the presentation. But typically, if you think of your parents I know my parents are slowing down. They're in their 80s. They've slowed down significantly, and they're spending a lot less money. A lot of my clients I sit down with that are in their 80s and 90s, their bank account builds up because they continue to get their pensions and everything else, but they're not spending it. And so now it's really a question of what kind of legacy are they giving the money away? How does that work? And so I want you to think of retirement really in 3 stages to make sure that you have clear goals early on in retirement to enjoy yourself, with the understanding that down the road, you'll probably slow down some. And that's what this chart is talking about here, is when we get into retirement, we absolutely know some definitive expenses that we're going to have, things like utilities and property taxes and things like that. So we know the specific expenses. We might have some goals in here. That's what these bumps are all about here, is that there might be a significant expense, a trip or a new car or something like that. Then there's the money that we might spend. So things that might happen in retirement as we go on, different things that we want to experience, but we're not really sure about all of that. And so we got to make some assumptions there. But there's a point in time as you get further and further into retirement that you realize most of our clients have more money than they're going to spend. Okay, going back to having that trouble of balancing retirement as well as with your having enough money to last through your retirement, people start creating this lump sum that's sitting there at the end, and that's where estate planning becomes really important. So legacy planning is while you're alive, what are some of the things that you can do, whether that's charitable giving or giving to your kids earlier, all those kinds of decisions need to be made, but it becomes really important to have a really solid will, power of attorney, personal directive. We're going to talk a little bit here about what happens as people age as well, but it's important to have that end of life plan as well. As much as we plan for retirement, it's really important that we plan for later in life as well. And this is really the reason why this was something that came out of that Sun Life presentation as well, is they do a financial literacy test for people from ages 60 to 94. The average mark on that test is 58%. Okay, so it's a passing grade. It'd be nicer if that number was a little bit higher. But the biggest thing is on the right here. You can see as we get older, our financial literacy comes down some. Now, I'm not going to say it's all about age. I think a lot of it has to do with just how much the business has changed. I look at when I started in 1993, this business doesn't even look anything like it did in 1993. So you can imagine somebody retiring today, and I had a lot of clients early on that were 60 who are now well into their 80s or 90s. And so they, things change a lot. And so that financial literacy score comes down. The problem is people still think their financial literacy is really good. And so you can see that the financial literacy scores go down in this slide here, but our confidence stays high. And so that's why I say, again, it's really important that you need trusted advisors around you, have a good relationship with your family and friends, whoever are your trusted people around you, to make sure as we age. Now, I do a lot of work with the charity, Alzheimer charity in Calgary, the Gordie Howe Cares Pro-Am. And I just know with a lot of my clients, I've seen it as they've gotten older, the decisions tend to change a little bit. So again, as much as you might be earlier on in retirement, you still need to have that long-term focus. And with taxation, it's the same way. When I talk about taxes, there's the tax implication today, the tax implication a year from now, but there's also the tax implication to your estate. And we need to balance all of that as we make decisions. So again, I think it's really important that you put trusted people around you and make sure that you have a solid plan, not just for your retirement, but right into your estate planning as well. We're going to jump into all the different sources of income people can get into retirement. And what I want people to realize is that there's not a single situation. All the people on this call have different situations. They might have pensions, they might have RSPs, they might have inheritance, they might work in retirement, they might have corporations. And so everybody's situation is different. And when we go through this and we do our financial planning, we need to optimize that. And it's not as simple as just saying, okay, I'm going to jump into my RSPs for a while, start taking money out. I'm done with that. Now I'm going to move into my corporation. There's a balance that has to happen. And we're going to show you that as we go through. But I'm going to address each one of these different retirement incomes that you might have. This is just a sample chart of one of the clients that we have, okay? And they've got a variety of income that's going to come in over the years, okay? So they've got pension that's coming in. They've got Canada Pension, Old Age Security, the government programs that they're going to have. They don't have any earned income in retirement, so they're not going to work part-time in retirement. They have corporate income, and then we've got our RSPs, the minimums that have to come out, tax-free savings accounts, some non-registered investments. So there's all these different things that are coming in. And again, you've got to figure out how to balance this, and it can make thousands and thousands of dollars of difference depending on how you pull that money out. So first, we're going to jump into earned income. A lot of our clients, especially if you go back, and I think Lucas is going to talk a little bit about this, so I might steal a little bit of his thunder here. When we set up social programs way back in the late 60s, people were retiring at 67 and they were passing away at 72. They typically weren't working. They didn't need a lot of savings. Things have changed today. The average person's retiring closer to 62. And then if you've got a couple that are 60 years of age, there's a 50-50 chance one of them will live into their 90s. And so your retirement plan needs to be at least 30 years long. Okay. And so sometimes people, again, were healthier at older ages. And so some people continue to work. And what I find is there's a lot of mistakes in financial planning between the ages of 65 and 71 when you have to convert a lot of your retirement assets to some kind of pension. So we've got to be careful about old age security clawback, because our tax rate can jump up from 30% up to 43, 44% if we don't do good planning in here. So if you have some earned income and you're late, you're 68 or 69 years of age, your accountant might say, oh, don't do RSPs anymore. You've got to convert it to RIF. And so you don't do that, but you might be experiencing old age security clawback, whereas an RSP deduction could eliminate that clawback. The thing with old age security and Canada Pension Plan is you have the ability to take Canada Pension Plan early and old age security late. So you have different ages that you can set that or start that. So for a lot of my clients that are working after 65, we start deferring their old age security clawback. There's no point in collecting it and then just giving it back to the government when we can defer it and get a larger sum of money once we're done working. they claw back at 15 cents on the dollar, and it starts at 79,000. So again, there's a lot of income splitting we can do, which is in the center here. So if you are married and you have a spouse, there's income splitting that we can do. However, typically with my clients, if one spouse passes away and all that income falls on one person, old age security clawback becomes a big deal, and it's significant. Most of my clients, they just take it as a matter of fact, where they say, oh, yeah, I've lost my old age security. And I'm like, hang on a second, let's see what we can do to try and eliminate some of that. There's a lot of planning that comes around that. Income splitting is something that the government makes it easier for us. From age 65, we're allowed to split our registered income with our spouse. But prior to that, we can do spousal RSPs. And so in a lot of cases, it's still important to do spousal RSPs if you might have a pension or if you might have a corporation in your name. And so it's really important to make sure we try and split income as much as possible. There's a big difference if one person earns $100,000 or two people earn $50,000, you're paying significantly lower tax rates. And so it's really important to try and work at splitting income. Okay. And there's ways of splitting income before 65 by using spousal RRSPs and things like that. The other piece is working part-time in retirement. And when we do financial plans, any year that a retirement gets delayed makes a significant difference to the back end of the plan. So if you feel like you're really tight on a retirement plan, just know that every year that's deferred of taking money out of your portfolio can add 10% to the back end of the plan. And so, people might retire from their current job and do either consulting or take on some, maybe working at a golf course or something. I've got clients that are doing that as well. But there's things you can do by, working part-time to eliminate how much you're taking out of your retirement plan earlier on. Okay. And so it's really important to, again, include all the different types of earned income into your financial plan. Now we're going to jump into pensions. Pensions are becoming less and less, and I'm not talking about government pensions here, Canada Pension or old age security. I'm talking about work pension plans. So typically somebody that might be, working for the government or teaching, or some of the oil companies in the past have had significant pensions, but we're seeing less and less of these all the time. So some of the advantages of having a pension plan, typically they're inflation protected, they are fully taxable. But the nice thing about pensions is, if I'm a conservative person, I know exactly as a pension, I'm going to get the same amount every single month. It's going to be bumped up each year. It gives me a lot of comfort. And again, going back to that retirement income specialist that I saw many years ago, he talked about the stress in retirement, and people that are on pension have a lot less stress in retirement than people that have, investment portfolios that are going up and down in value. Obviously, we have no control over people like Vladimir Putin and the things that are going on there that can drive markets up and down. We have no control over inflation, and there's things that are happening all the time. And then governments are putting in new budgets all the time. And so there's constantly things that are changing that impact our investment portfolios. And that's the nice thing about an employer pension, even though there's fewer of them, is we don't have to worry about that. However, if you go back to what I talked about before, there's positives and negatives to everything. If you go back to what I talked about before, where you have 3 stages of retirement and you might want more money earlier on in retirement, some people can commute their pension and take out a lump sum. This gives them the ability to perhaps enjoy their earlier retirement more. It gives them the ability to take out lump sums, because you can't come to me if you're collecting a pension. You can't come to the pension company and say, hey, I need $20,000 for a trip. You're going to get your $4,000, $5,000 a month or whatever it is, and you can't really change that. And so there are things to consider around pensions when you're making those decisions. And the other piece is the estate planning protection that you get from the commuted value versus the pension. Pensions have some guarantees, but once you pass away, and typically your spouse passes away, that pension is gone. Whereas if you have the commuted value, that's an investment, that's part of your family assets, and that would pass on to your next generation or charities or wherever you might be leaving your money. Now, the pension credit's really something that's important to be aware of here. If you have a if you have a personal pension of any kind, the first $2,000 you earn every year is tax-free. You've got a tax credit on your tax return. So that works before age 65. If you don't have a pension, then you want to convert some of your RRSPs to a RIF. So I've had clients that either by continuing to work or having other assets they kind of just leave their RRSP until they have to convert it at age 71. But you want to make sure that you're taking out at least $2,000 a year, either from pension or from RIFs, because that's tax-free, and that's going to save you, probably $800 a year in taxes by making sure you take advantage of that pension credit. That's something that I find is missed very, very often. And so you want to stay on top of that. The next piece we're going to talk a little bit is about these government programs. It's something that always comes up when my clients are retiring, or even if they're not retiring and they're hitting age 60, should I take my Canada pension plan early and stuff like that. So we're going to make the math a little bit simpler for you here. And what we're looking at, if you retire today and you're 65 years of age and you get 100%, you qualify for 100% of the Canada pension plan, that's $1,253 a month. Okay. Now, let me go back here. So what we showed you here is based on life expectancy is by age 70, if you took it at age 60, you'd have $96,000. You have $75,000 if you took it at 65. And of course, if you were deferring it to age 70 and passed away at age 70, you'd have collected zero. Now, the longer we live, the more the benefit goes to deferring your Canada pension plan. So mathematically, and when I do financial planning, there's always the math side of things, but there's always the life experience side of things. And so it's not as simple as just a math calculation to me. So if you are looking at really enjoying yourself earlier on in retirement, you might look at collecting Canada pension plan earlier, making sure that you're collecting this money, enjoying it, with the fact that later on, most likely when you're 85 and 90, you're not spending as much money. Okay. And so it might make sense sometimes mathematically defer if you can guarantee that you're going to live to age 90. I'd like to know your doctor, but ultimately we have no guarantees. And so again, I really focus to make sure that people enjoy the earlier stages of their retirement. And so there's some, I guess, a lot of questions around Canada pension plan. But if you look at the other incomes as well, if you're still working after age 60, should you take it? Maybe not. If you're looking to do different things like travel or buy vehicles or pay off debt, maybe that's something that can help you do that. So everybody's situation is different. It's not as simple as the math. We got to look at it in a couple of ways. The old age security is something, it's a little bit more complex because you have these clawback levels. So if you're 65, the maximum benefit right now is $642. They have bumped that up significantly in the last year. If you're already collecting that, you would have seen that. But again, you can defer old age security to age 70. Typically where this works is if you're continuing to work after 65. Some people, they work because they have to, and some people work because they want to. And so we just want to make sure that, again, here's the math numbers. If you live past age 90, you can see that you collect significantly more if you had deferred it to age 70. But again, if you're getting a bunch of extra money at 85, 86, 87 years of age, I'm not sure how beneficial that is, depending on the rest of your financial situation. So there's a lot of questions around government programs. So don't just assume, okay, I get my government programs and what I get is what I get. There is a lot of planning that comes with that, not just your other investments. Okay. And that's what I was talking about here, is that the decisions around government programs should be based on, I believe, the phases of retirement. And so you got to look at, when do you need that money? What are the other sources of money in retirement? And that'll help you make the decision of whether you take Canada pension plan and old age security early or late or whatever it might be. I'm going to jump into corporate income. I'm not going to spend a lot of time on this because this is really more specific to different individuals that might have a corporation. But corporations, again, are something that you need to do a lot of planning on. They make sense because we defer a lot of our income within the corporation. But unfortunately, when we take out dividends, it can cause a lot of trouble with our old age security payments again. Because dividends are grossed up on our tax return. If you don't understand the way taxes go, if you earn a dollar of dividend on your tax return, they gross it up and then they give you a tax credit later on. The problem is, once you gross it up, that's when they calculate your old age security clawback, and the tax credit comes back later. So a lot of retirees, I hear it all the time when we're looking at investment shows, you should always look for dividend producing companies and things like that. In a lot of cases, that's true. But in some cases, if you are around that $80,000 a year of income, it could be a negative. And so again, be careful with the type of income that you're paying yourself. The other piece is winding up that corporation. Once you retire, with all the other assets that you have, if you have RRSPs as well and tax-free savings accounts and other non-registered money, you need to be careful to to decide when you're going to wind up that corporation, if you do it over 1 year or if you do it over time. Okay. The next we're going to look as RSP minimums, RIF minimums, and pension minimums. If you have a pension plan and you have decided to commute that pension plan, you can see here that there's minimums in our RSPs and our LIRAs. Now, you have to convert this money to a LIF or a RIF by age 71. But like I said earlier, you can do it earlier. You don't have to wait to those ages to convert it. And then there's minimums that have to come out each year. So you need to make sure that you manage that. So when the example I said earlier of triggering $2,000 a year of pension income, I'll take my client's RSP portfolio and I might just take $12,000 and I'll roll that to their RIF. You can leave the rest of the money in an RRSP, and then we'll take $2,000 a year out of there. So the nice thing about converting an RSP to a RIF is before age 71, it can be reversed. However, if you do the LIRA to a LIF where your pension is being converted to an income stream, you can't undo that. At age 50, you're allowed to unlock the pension in Alberta, and then 50% of that money can be rolled into an RRSP where it's more flexible. But the 50% that stays in the LIRA or the LIF is very restrictive. So you can see that the minimums for a LIF is the same as an RSP. However, there's maximums that can come out each year. And so that's based on the previous year's performance and your age. And so that has to be factored in each year. So typically, if somebody has a LIRA and a LIF and an RSP, I'll make sure that we're taking out the maximum from the LIF and supplementing their retirement plan with the RIF. So we just want to try and wind down that LIF as much as possible because of the, and I'll show it a little bit here in the next slide. This piece here is really talking about the tax brackets. In Alberta, well, in Canada, we have a marginal tax rate system. So the more money you earn, and if you think back to the old age security clawback stuff, in this area here between 50 and 98,000, you're paying 30% tax. But if you have old age security clawback, that's going to jump up to 43%. So when we're doing retirement income planning, we're really paying attention to all these marginal rates. It doesn't matter really where you fall in, but when we're taking money out, we're going to try and get you to the top of that tax bracket. If we can keep taking money out at 25%, as an example, let's say two of you are alive, you need close to $100,000 to live on, we're going to try and keep your income up to that 49,000 to make sure we're pulling out all your money at 25%. Because sometimes if you defer it, you know, with minimums that creep in after age 72, your income might be bumped up significantly. Or if you've lost a spouse and then all the assets are combined into one name, it's very quickly that you can jump up tax brackets. Okay, and all of a sudden you might be paying 25% in retirement, and then you're jumped up to 36 or 38% without doing planning, making sure that you're pulling money out as you go. All right. The next, this is a chart, and I know there's a lot of numbers here, but this is just showing you the minimums and the maximums of a LIF program. So the minimums are exactly the same as what you would have for a RIF as well. And you can see the older you get, the higher the percentages. So once you're up into, this is where it causes a lot of problems. And a lot of my clients have come to me going, oh, I wonder why I did RSPs, because now I'm paying all this tax. They forget about the tax savings from early on, but realize they're paying a significant tax in their retirement. They may not need that money. So I might be, 84 years old and they're forcing me to take out 8% for my RIF, and I don't need it. And that causes a problem. Okay. Now the government, the one nice thing they did a few years back is they did lower the minimums that we need to take out because people are living longer and they need this money to last longer. But I just want people to realize there's a lot of planning that goes around these minimums and maximums that you get out of your RIF and your LIF. Now I want to jump into something that to help people understand with tax-free savings account. I mean, they've been around now for 13 years, but there's been a lot of questions about tax-free savings accounts, what they can do for people. Now, one of the things that bothered me when Justin Trudeau came out and he spoke about tax-free savings account many years ago, and he said they were really just for the wealthy. And I don't want to make this a political conversation, but I'm going to disagree significantly. As we talk to our clients all the time, if you're in a lower tax bracket, so if your kids are in a lower tax bracket, it may make more sense for them to do a tax-free savings account than an RSP. And I'm going to show you that here. Now, in the budget that was released this week, there is a new first-time home buyers program that they're instituting that'll start in 2023. I think it's an excellent program to help people save for a home. The biggest difference is we have the home buyers plan where you could contribute to an RSP, you could borrow from your RSP tax-free, put it towards your first house, but you had to pay that money back over 15 years. The new program, you're not going to have to pay it back. You're going to get the tax deduction. You can use it to buy your first house. And I mean, I see a lot of comedians and different people talking like kids nowadays coming out to buy a house is a very difficult thing because the cost of housing is so high. And so, they need to have ways to save for it. But in this situation I'm showing you here, somebody has $20,000 to put into an RSP or put into a tax-free savings account. Now, if we're in the 40% tax bracket or 36.8% tax bracket, you're going to get $7,200 in tax savings in your RSP. The problem with most people is they're going to turn around and spend that tax savings. Now, if I put that same $20,000 into a tax-free savings account, I'm going to have zero savings. Okay. Now, I'm assuming a 7% rate of return over the next 20 years. Okay. Now, we're going to have $60,000 of growth. That's just the rule of 72. Anytime you earn 7.2%, your money will double every 10 years. So 20 years later, my $20,000 at TFSA will be worth $80,000. My $20,000 in the RSP will be worth $80,000. I saved $7,200 up front, but now I got to pay tax on this RSP when I pull it out. Okay, so $80,000 less $24,000 of tax, assuming I'm in a lower tax bracket when I'm retired. So I saved at 36%, but now I'm in a lower tax bracket conceivably in retirement. I'm still paying $24,000, so that $80,000 is only worth $56,000. Whereas my $80,000 in the TFSA is worth $80,000 because it's tax free. So I'm not a proponent of doing tax-free savings accounts over our RSPs. I'm just saying if you're in a lower tax bracket, it doesn't make a lot of sense, especially for younger people that'll most likely be in a much higher tax bracket as they age. And so it's really important to plan ahead. And so we just actually had this conversation with one of our clients this week saying, why didn't we do an RRSP? And we're saying, well, these are the reasons. Your tax-free savings account is more efficient right now, and we'll do an RRSP once your income goes higher. And so, back earlier, if you're talking about pensions, people that might have pensions, again, you've got to be very careful that you don't overfund your retirement. I'm fighting with a lot of financial plans where we're forced to take a lot of money out of RSPs, which are taking our clients beyond what they truly need for their retirement. And so all I'm saying is you really need to have a conversation between doing a tax-free savings account and an RRSP. I love the tax-free savings account for so many reasons, especially people that are retired. Continuing to contribute to that tax-free savings account creates tax-free estate and gives us a lot of flexibility if we ever need money. It's a much more tax efficient way of saving for some more lump sum expenses versus an RRSP. The next thing we're going to look at is non-registered investments. This is really just that non-registered investments are taxed very differently. $1,000 of interest is not the same as $1,000 of capital gains or $1,000 of dividends. Now, in the last budget, I've read a lot of articles. People are, really worried that the government might increase the capital gains rate. They didn't do it this week. It's always a possibility, but we're still going with the 50% capital gains rate here. So you see $1,000 of interest. If I'm in the top tax bracket, and I earn, $1,000, I'm only netting out $520 after I pay tax. Now, if I earn dividends in a foreign company, like a US company, it's the same thing. It's just taxed like extra interest in my portfolio. Now, interest rates are starting to creep up, and savings accounts at the bank where interests were really low, they might still be low, but there are options to get higher interest in your bank account. You got to be very careful because even at 1%, you're only netting out say 60 or 70% of that, and so after tax. So be careful about the tax implication of having too much interest from bank accounts that are too big. Now, eligible dividends, Canadian dividends, you get a dividend tax credit like I talked about before. It's a complicated, tax system, but it's just a way of what the tax authorities are trying to do is make sure if I earn $1 of salary or $1 of dividends from my company, the corporate rate and the dividend rate should be really close to what I'd be paying on salary. So that comes out as you'll pay another $343 of tax, and so you'll net $657, and then obviously capital gains are very attractive because you're only paying tax on half. There are other abilities in non-registered plans that you can also do, like a return of capital. And return of capital is just really deferring the tax. So your tax will be bigger on the back end, but you can pull out money earlier on at lower rates, and it's kind of like a prescribed annuity is a similar kind of thing. So so it's really important that the type of investment income you earn. And so for a lot of our clients, we'll make sure there's more interest earning investments, and your more conservative stuff is in your RRSP. And I do that for two reasons. One is it doesn't matter what comes out of an RRSP, it's fully taxable. So if I'm earning capital gains there or dividends, it doesn't matter, it's the same tax rate. So you might as well have your interest in there. It also means that you're not going to earn as much as you might earn in your non-registered portfolio. So as a whole, you might have a balanced portfolio, but all my capital gains and dividends are in the non-registered side. All my interest is in the RRSP side. And so you'll be much further ahead tax-wise. The last piece is really looking at a shortfall. And so we've done a lot of studies on the sustainability of your portfolios over time. And this is the actual performance of the stock market since 1970. And so your withdrawal rate on a 60-40 portfolio, so we always talk about that, a moderate portfolio. As we get closer to retirement, should we be more moderate or more conservative? I want you to be very careful when you make that decision, because people got more conservative 30 years ago because they didn't live as long. Now, if you've got a 30-year retirement plan and we've got inflation as high as it is today, we've got to make sure that we earn enough money to last through our retirement. But this is the sample withdrawal rates. If we pull out at 8% from 1970, our money lasted about 17 years. Okay, if we pull out at 7%, our money lasted 25 years. So 6% got you 40 years. So if you're 60 years of age, 6% is probably not a bad withdrawal rate, because you'd have to live beyond 100 years of age before you're going to run out of money. And again, I don't think that's most likely going to happen. And then obviously 5 and 4% make the plans extremely sustainable. So it's very important to understand your withdrawal rates in retirement. And we will do some of that work through our financial planning to show you the impacts of different withdrawal rates on your overall retirement plan. Now, this is a case study there's a lot of, things going on in this chart here, but this is taking all those different sources of retirement income, taking a current situation on the right-hand side. This teal green here are all your minimum withdrawals that this client's experiencing from their RRSP. You can see it's fairly significant. The stuff down here is pension, and then you've got government programs in here. This light purple here is RRSP income. Okay, so you can see what we did for this client is we actually took out large sums of RRSP earlier on in their retirement, which means that this forced withdrawals were much smaller. Okay, and so this is just something that worked in their situation. Like I said before, everybody's different, but the big piece is here's the difference over time. Is in the current situation, if they just took out money the regular way, took out the minimums the government forced them to do, they're paying $2.4 million of tax over their lifetime. With the recommended plan, by paying a little bit of extra tax earlier on, we pay significantly less tax later on. And you can see that by doing some income planning and cash flow planning in retirement, it saved them $450,000. That's significant money over time for your retirement that you're not giving to the government and you can use yourself. And so you've got to be very careful as you go into retirement to make sure that you do a lot of significant planning around that different types of retirement income. That's the end of my presentation. I know I went through this stuff very quickly. I'm going to pass it on to Lucas, and he's going to talk about what peace of mind retirement looks like. All I can assure you is that the planning that we do and the software that we use answers a lot of the questions that I brought up in the first part of this presentation. And when you do solid financial planning, it will bring you peace of mind. But again, I'm going to stop here and pass it back on to Lucas, and thank you for your attention today.
Great, thanks, Rob. So that was a lot of information thrown at you on all different sources of income and the tax implications of all those different sources as well. So it's a big piece of what retirement planning looks like, but there's also many other areas that we look at when it comes to financial planning. So that's really what I'll be talking about to wrap up the presentation, is just what a holistic financial plan looks like. And really the feedback that we get from our clients when we do this type of planning, is peace of mind. So they can go through their retirement knowing that their finances and everything like that has been taken care of, and they can focus on values other than money. So the first thing to note is retirement is not an event. When we do retirement planning, it's not like we put together a plan and then never talk to people again and that's set in stone. A good attribute of a financial plan is the ability to adapt to life, because we know as soon as we put a retirement plan into place, something will change in our client's life, or something will change with rules or tax laws or everything like that. There's a lot of uncertainty out there. So as we progress through retirement, changes and updates and proactively monitoring this plan is a huge portion to having a good, solid financial plan. The other piece to this is it's never too late to put a retirement plan in place. So for those on the call who are already in retirement, it's not like you've missed the boat on putting a plan together. There's lots of planning that we can do moving forward to improve your situation. So this is a stat that Rob referenced earlier, just talking about the change in landscape of retirement for Canadians. So as he mentioned, in the early 70s, people were working late into their 60s. Life expectancy is in the 70s at that point. So they were planning for 10, 15-year retirements. Now what this is showing is that for a retired couple, there's a 50% chance that one spouse will live till age 90. And these days, people are retiring earlier, some in their late 50s, some in their early 60s. This means we need to plan for 30, 40, 50-year retirements. And the level of detail and level of planning that needs to go into that is much higher to ensure that longevity, as Rob talked about. So what you're seeing in front of you right now is a snapshot of our financial planning software. This takes into account all the different pieces of your finances. So I know we were specific in today's presentation about cash flow and taxes, but that's only one piece of building a retirement plan. So some things to note in this screenshot here are a goal coverage. We say there's no such thing as a cookie cutter retirement plan. All of our retirement plans are based around each individual's retirement goals, and that can be different for everybody. So if you're in retirement, it's how much cash flow do I need through those stages of retirement? And if you're approaching retirement, it's when can I retire? That's a big question for people. And then based on my lifestyle, how do I continue that through the years of retirement? So this software will actually score your ability to finance that goal that you've put into it. And for this example, it's at 109%. Then you'll see a list of strategies that we could implement into this person's retirement plan. And that's really where Rob and I come in, is testing all of these different strategies to see if they make sense for this individual, because they might make sense in this plan, but for the next person we sit down with, it won't make sense. You'll see along the right-hand side is some of the strategies that we've already put in. So you can see, just like Rob was talking about, delaying CPP till age 70, it quantifies that in terms of how it affects your net worth over the retirement plan. So this is a good way to test the strategy and say, how much of an impact does it have when I look at deferring CPP? Then you'll see a list of other goals that we can plan for within retirement. So we can plan for major purchases, whether that's vehicles or vacation properties and things like that. And how does that fit into your retirement plan? And then finally, legacy goals. So if we do our planning properly, our clients die with money. And then the question becomes, where do we want that money to go? How can we most efficiently hand that down to the next generation or charities or whatever your goal might be around the estate planning? So that's a baseline scenario of what we look at for our clients when it comes to the plan. But we also stress test our plans with what if scenarios. And these are by far the most interesting conversations we have with our clients, because we know if we don't have this conversation with them and we go through the plan, they're going to go home and start talking about, well, I'm reading in the news inflation is higher. How will that affect my retirement plan? So we can actually say, instead of historically inflation being around 2%, what if for the next 30 years, if inflation jumps to 3%? How does that affect my retirement plan? So if I need to pull more from my investments to sustain my lifestyle, what does that have an impact on my plan? And then you can see all of the strategies that we can implement if this what if scenario comes into play. Another big one is, what if the market crashes? So this is the uncertainty. When it comes to planning, we can create a lot of certainty, but when it comes to the investments, we ultimately can't control what markets do. So we can say, what if the market crashes early on in my retirement, having the biggest impact because my money then needs to recover and provide income for the next 30 years? So our clients can wake up in the morning and say, if they see the market has crashed, they'll still know they'll be okay because we've stress tested that plan in that way. Now, like I mentioned, what's your number? Every plan we sit down with is unique. So really, for those on the call today, your number might be 70% of what you're currently spending now for those pre-retirees who are listening. Some are saying it's closer to 80. So these are rules of thumb that we often hear in the industry, but ultimately a financial plan based around your current situation and your goals will answer that number. And then you can see if you plan to travel. So in those go-go years, a lot of people will continue to spend the same amount of money they did pre-retirement in that first stage of retirement. So all things that can be built into our financial plan so that we get away from using those rules of thumb and actually use the realistic numbers for our clients. So the last thing I'll take you through is just a summary in terms of our process, what we do on a day-to-day basis, sitting down with our clients. And really, as certified financial planners, this should be standard across the board. But it's essentially a two-meeting approach. So when we sit down with new prospects, what we do is in the first meeting, explore their current situation and clarify their goals and objectives. And that's all we're really going to look at in that first meeting. So we really want to understand what's important to you in terms of when do you want to retire, all this money you've saved up, what is it earmarked for? And then once we know all that information, Rob and I take that, build a financial plan, and then in that second meeting, we present the plan to you. So there's no cost or obligation to go through this process with us. Ultimately, the reason we do this two-meeting approach is because in that second meeting, we present two scenarios. So we have a baseline scenario, life as if you never met us. We'll project that all the way out for you. And then we have our ideas, recommendations, strategies around cash flow, investments, all of those different things in another scenario. And we can actually quantify the difference that it makes to your net worth. So at that point in time, it becomes a really easy business decision. Does it make sense to move forward and implement this planning? Or is what you're currently doing going to get you to all of your goals? So then obviously, if it makes sense, what we start doing is implementing that plan. And then, like I said, a good financial plan is one that adapts to the changes in your life. So we're very proactive in monitoring and adjusting these plans. Now, just a snapshot of our team again. We feel we're very uniquely positioned in the marketplace right now. There's a big gap we find out there for pre-retirees and retirees not getting this type of planning. And this is something that Rob and I have been doing for years and decades actually with our clients. So we feel like we have a tremendous amount of experience taking our clients through retirement. We've done it hundreds of times. For everyone on the call today, you get one shot at ensuring your retirement and all of your funds last all the way through. So I've gone through myself and Rob's background in terms of our experience and level of expertise, but we couldn't do what we do without our team working for us. So we have Maggie and Kim, who are our administration team, and they're wonderful. They essentially free up our time so that we can focus on what's important is financial planning. And then we have Jamie Buchan, who's our business development coordinator. So he's actually in charge of ensuring we run our practice properly and optimizing things. And really, he's a huge asset for us to have. And Jamie, he actually coaches some of the top financial planning practices in Calgary, not just at IG, but at all different institutions. And our biggest compliment from Jamie is that he's decided to work with us personally for his own finances because he really believes in our planning ethic and what we do for our clients. And he sees the value in doing a complete holistic financial plan rather than just looking at one area like taxes or investments. So you'll see on the right-hand side of the screen, our clients' experience is having a team of experts working around them. So obviously, us at IG Wealth doing their financial planning, we have great relationships with a lot of our clients' accountants and lawyers. We want to make sure that we're communicating all of that information so nothing gets slipped between the cracks. And then as well, we have a suite of lawyers, accountants, actuaries at our head office called our Advanced Financial Planning Team that we can bring in for more complex scenarios. And that's a huge value add at no cost to our clients. Then you'll see along the bottom, we have preferred partners that we use. So this really talks about the product that we implement into the financial plan. So the investments and all these different sub-advisors that we use, it's a very unbiased approach. Rob and I have special licensing where we're not limited in terms of the product that we provide. So we act as brokers, meaning we can provide any investment under the sun for our clients. We don't ever want the investments and the product to get in the way of the planning that we do for people. So that sums up our presentation for today and our team and really what we do. We did receive a few questions as we went through the presentation. Quickly before we get into those questions, I did want to mention that we will be following up with everyone. These presentations, they are for educational purposes, and we love getting people's feedback in terms of what did you like, what maybe didn't you like, and was there anything missing out there that is a need in the marketplace where people are wanting some information that we could put into a future presentation. So thanks again for everyone being here, and I'm going to start reading off some questions, and Rob can get to those.
Thanks, Lucas.
So the first one is what is it meant by grossing up dividends?
Yeah, it's just a complex way that the government and the CRA does our taxes. When it comes to dividends, what we have to understand is the dividends are really the second tax that's paid on corporate income. And so you're going to have the corporate tax, and then personally, we pay this dividend tax. And the idea is that the corporate tax and the dividend tax is equal to what we would pay tax on salary. And so there's no real added benefit to the income stream coming out of a corporation versus us taking out of salary. The advantage of the corporation is that, you know, the money can grow tax-free in the corporation until we pay out that dividend. But how it works is the government takes your $1 of dividends and they gross it up on your tax return. So they calculate a tax rate on a higher dividend, and then they give you a tax credit later on to reduce that dividend. So in the end, you pay less tax than you would say on interest income. But like I talked about before, is the way the government calculates some social programs, whether that's, I've talked a lot about old age security. I don't want it to be focused on that. That's one example. The Alberta government has different income levels where they support people. And so you got to be really careful, because typically they'll look at page 2 of your tax return and what your taxable income is. But with all these tax credits that come later, our income, comes down, or the tax rate comes down, but we might lose access to some government benefits because of that. So again, they take a $1 of dividend and they actually charge a tax on a higher rate with a dividend tax credit later on.
Great. So another one that came in is, how do you guys charge for what you do?
That's a great question. We've really changed over the last bunch of years. Again, I've been here for 29 years. What I can assure you is it's very transparent. It's not the same for everybody, because it's really based on the asset level a family group will have with us. So again, this includes grandparents, parents, children, it includes the whole family unit. And the more assets somebody has with us, the more that fee comes down. So it's as high as 1.35% to as low as 0.3%, depending on the assets. And again, typically, probably on average, our clients are around 0.9%. That's what's is used by the company for paying people like Lucas and myself, and how we pay our team, and then of course for the company as well. So it's somewhere in that range. But the nice thing is it actually shows on your statement, so you'll know exactly what you're paying every year for our financial planning and for our advice that we give you.
Great. So the next one is, Rob and Lucas, do you do tax returns?
No, we don't do tax returns. I actually practice on some tax returns every year just to stay on top of it. But we will work either with your accountants and lawyers, and people that don't have accountants and lawyers, we have other ones that we refer our clients to make sure that their taxes are done properly and their wills are done properly. So obviously we want professionals doing that, but Lucas and myself both, we stay on top of all of that stuff, because obviously we need to understand the impact of our decisions on tax returns. And then the wills and powers of attorney, that is something we didn't spend a lot of time on it today, but it's so important. I've dealt with many estates where people have passed away without a will, or even when they passed away with a poorly drawn up will, the problems and how families can be torn apart. It's really sad. So no, we don't do it, but we'll make sure that we refer you to somebody that can, if you don't have those professionals yourself. And again, like Lucas said earlier, we want to work with your professionals because we want to make sure that we communicate and that we're all on the same page as well.
Great. So the last question we have is a hot topic right now. How did the budget impact us?
Well, there was a lot of fear with this budget coming out and the alliance between the Liberals and the NDP that there might be a lot of tax changes and going after, they talk about the ultra rich. So there's some things that are built in there, but for the most part, this budget left a lot of the main things affecting most of us alone. But there's some good programs in there helping people to buy their first home. I'm not sure if you're here for a retirement income seminar, you're probably not necessarily looking at buying your first home. But for your kids or grandkids, that might be something that's really important. So they put some programs in there to help people buy their first home. But for the most part, there's not massive impacts to us individually yet.
Great. So that's all the questions we had. For those who are still on with us, please feel free. Rob and I will stick around for another 5 minutes. If you have any other questions, please don't hesitate to post those in the chat. As well as we have posted our website that everybody can check out. It'll give us a lot more information on what we do, and then our calendar link as well. So if what you saw in today's presentation definitely is something that you want implemented or want to go through the process to see what a financial plan looks like for your situation, please don't hesitate to book a time with Rob and myself. We are offering that for everyone on the call. So thank you everybody for attending.